Hi guys, so let's move on. Last time we were considering the policy responses to inflation. In this lesson we're really going to focus on evaluating inflation and whether it truly is a problem and who it's likely to be a problem for. Okay, so the number one point really to think about is firstly that when it comes to inflation and when it comes to these different policy responses that we've looked at, there may well be a conflict with macroeconomic objectives. So firstly, high inflation, well, that runs contrary to the sort of government objectives that want to be obtained within most economies. So firstly, that's a problem. But then when it comes to perhaps using interest rates, and increasing interest rates, that's going to dampen the level of aggregate demand, of course. And is that a good thing? Well, you're slowing the growth of the economy, and if the pressures are as a result of cost push, then that may be bad news for economic growth. Okay, next point. If inflation is anticipated, is there a problem? Because remember, if you can actually anticipate what is happening with inflation, then it means consumers, businesses can respond and plan for that. It also means that policymakers can also plan for that as well. So is there truly a problem if inflation is anticipated? The big problem generally is, though, within LEDC economies, higher inflation isn't well anticipated on the whole, and that is when there tends to be a problem. Okay, next point: can the level of inflation rather actually be controlled? So we live in an enormously globalized world, and of course there are things that are simply beyond the actual ability of policymakers to actually control. So the Monetary Policy Committee may well actually consider changing interest rates, but that's not to say that's going to have any effect, for instance, on oil prices. Or if the Federal Reserve Bank in America has reduced interest rates and therefore there is a greater supply of US currency available, then it may well mean that there may be an increase in aggregate demand globally because of the economic might of a country like the US. So to what extent can inflation be controlled? It's a difficult one, isn't it? Okay, there are certainly areas beyond policymakers' control. So therefore, what you could argue in relation to this is perhaps core inflation would be a better target. This, of course, strips out those goods that are likely to have volatile prices, those commodities. Okay, next point. High demand pull inflation will also bring employment benefits and profits, higher profits for businesses. So actually, is that a good thing? Then, how severe are the effects of the inflation? Well, this is likely to depend upon whether real wages are actually keeping up. And if real wages are actually keeping up with the level of inflation, they're moving in line together, then there may not be a big problem being actually observed when it comes to consumers and households' expenditure. Okay, it really does just depend. However, if you are in a circumstance where people's real incomes are falling, then that is when the severity of inflation is really powerful. Okay, then how long is inflation expected to rise? So over what period are inflationary pressures expected to last within the economy? Okay, and our final point is a very technical one here, but it's a lovely one to consider if you fancy that, and it is really just about LEDCs and MEDCs and the difference when it comes to the actual policy credibility that their policymakers are likely to have. So MEDCs tend to be treated with a lot more respect because of their solid macroeconomic performance or their macroeconomic policy decisions, which are meant to be taken with a long-term interest in the economy. When it comes to LEDCs, they don't have that same degree of policy credibility. So how do you actually go about combating inflation within an LEDC? Well, some countries have really taken to the extreme and gone for dollarization of their exchange rate, so getting rid of their whole currency and just having dollars as their primary currency, because of course then policymakers can't actually influence the domestic money supply, so they have no influence on it, and that reassures the markets in effect. The sort of halfway house alternative, of course, which is most commonly used, is to use an exchange rate peg. Fixing your exchange rate, of course, will limit the exchange rate volatility, and that will help to reduce perhaps the cost push pressures within the economy. Okay, guys, so that's it. You know, one further area you may just want to think about if you're discussing these policy responses that we looked at is what sort of time lag is actually involved. And of course, the time lag is going to be greatest when it comes to these supply side policies. When it comes to fiscal policy, well, that's likely to take a time period before its introduction, because you've got massive corrections that need to be made to all businesses changing their prices and so on. So monetary policy, as we've said, is the go-to, but even that is going to have a shorter term time lag. Okay, right guys, thanks a lot.